In this lecture, we will cover the importance of professional judgment in the conduct of an audit. Professional judgment is essential to the proper conduct of an audit. This is because interpretation of relevant ethical requirements and standards and the informed decisions required throughout the audit cannot be made without the application of relevant knowledge and experience to the facts and circumstances. Therefore, it's important for auditors to use a framework that helps guide them in making more informed and unbiased judgments. We will cover today what good professional judgment looks like and what are some of the tools that auditors can use to mitigate judgment biases.
We will address several key questions. The first is, what is professional judgment? Why is it important? What does it look like in auditing and accounting? What areas do auditors exercise professional judgment? We will also talk about the steps in the judgment process, as well as identify the common biases that impact judgment and decision making, and the approach that we can take to mitigate the effect of these judgment biases.
Professional judgment refers to the informed and thoughtful decision-making process that individuals with expertise and knowledge in a particular field employ when faced with complex or ambiguous situations. It involves weighing various factors, considering available evidence, and applying one's experience and expertise to arrive at a well-reasoned and appropriate conclusion. Professional judgment is often used in professions such as auditing, where there is no clear-cut answer or where standard procedures may not fully address the nuances of a situation. It is characterized by objectivity, critical thinking, and the ability to balance multiple perspectives and considerations to make sound choices. If you relate professional judgment to an audit setting, the task of risk assessment or evaluating estimates established by management, these all require auditors to exercise professional judgment. These judgments often occur in a setting of uncertainty and risk. As an example, management is required to establish an obsolescence reserve for inventory under GAAP. While GAAP provides guidance to managers about how things should be considered in establishing the obsolescence reserve, the standard is very much principle-based in that there is guidance but no set rules. In other words, there is no formula that is mandated by the standards. Therefore, judgment is involved in the process of establishing the reserve. The uncertainty arises because two people can look at the same set of facts, the same information, and arrive at very different decisions. An auditor then must come in. Management tells them, we've established the inventory reserve as X, and then the auditor has to evaluate the reasonableness of that observe. So they view management's inputs, they view management's assumptions, and they arrive at a decision. Whether they agree with management's assessment of the obsolescence reserve or they believe that it should be adjusted, another auditor can come in and view the same set of facts and come up with something very different. But more importantly, in situations where auditors can be challenged, such as being challenged by the PCAOB on their decisions, this creates some level of risk and also adds to the uncertainty. It doesn't mean that the auditor's decision was wrong necessarily. It just means that either the regulators think that the auditors did not look at the appropriate amount of information or facts, or they disagree with the conclusions that the auditor drew based on the facts and assumptions that they evaluated. So that's where the risk comes in and the uncertainty. Capital market participants and other stakeholders expect auditors to exercise professional judgment for several important reasons. 1, the complexity of transactions. Businesses engage in a wide range of complex transactions that may not have straightforward answers. Professional judgment allows auditors to evaluate the intricacies of these transactions and make informed decisions on their financial reporting and disclosure. Adherence to standards. Auditors are required to follow auditing standards and guidelines while conducting audits. However, not all situations can be anticipated by these standards. Therefore, professional judgment allows auditors to interpret and apply these standards appropriately in unique scenarios. 3. Risk assessment. Auditors need to assess the risk associated with financial reporting, including the risk of fraud or misstatement. Professional judgment helps auditors identify and prioritize areas of higher risk, allowing them to allocate resources effectively. 4. The subjectivity in accounting. Many accounting principles and standards involve a degree of subjectivity. For example, determining the fair value of certain assets or estimating the useful life of an asset requires judgment. Auditors need to ensure that their judgments are reasonable and consistent with these standards. 5. Changing business environment. Business environments and industries evolve over time, leading to new and complex transactions. Professional judgment enables auditors to adapt to these changes and apply their expertise effectively in novel situations. Timeliness and efficiency. Auditors often work with time constraints to complete audits. Professional judgment helps auditors make timely decisions without compromising the quality of the audit process, therefore enhancing efficiency. 7. Stakeholder confidence. Capital market participants, such as investors and lenders, rely on audited financial statements to make informed decisions. Stakeholders expect auditors to exercise professional judgment to provide them with accurate and reliable information that reflects the true financial position of the company. 8. Transparency and accountability. Auditors are accountable for their decisions and conclusions. Exercising professional judgment and documenting the rationale behind their decision enhances transparency and accountability, allowing stakeholders to understand the basis for audit opinions. 9. Maintaining auditor independence. Auditors need to maintain their independence and objectivity while conducting audits. Exercising professional judgment helps auditors stay independent by making decisions based on facts and evidence rather than external pressures. 10. Legal and regulatory compliance. Auditors must comply with various legal and regulatory requirements. Professional judgment ensures that auditors appropriately address these requirements while conducting audits. In summary, the exercise of professional judgment by auditors is essential to address the inherent complexity of financial reporting and auditing. It helps auditors adapt to changing business environments, assess risks, maintain independence, and provide stakeholders with reliable and relevant information, thereby enhancing confidence in the financial reporting process. Audit judgments can be classified along a continuum based on the level of structure and standardization involved in making those judgments. This classification helps understand how auditors approach different types of decisions during the audit process. The first level would be structured judgments. Structured judgments involve decisions that are based on well-defined criteria and established guidelines. These decisions are often routine and standardized, requiring little room for interpretation. Auditors follow predefined procedures and rules to arrive at their conclusions. Examples of structured judgments in auditing include performing mathematical calculations, verifying straightforward documentation, and comparing financial figures against predetermined benchmarks. These judgments are relatively straightforward and have a low level of subjectivity. The second level would be semi-structured judgments. Semi-structured judgments fall between the extremes of structured and unstructured judgments. They involve decisions that require some level of interpretation and analysis, but are still guided by established frameworks and principles. Auditors use their professional judgment to assess situations that may not have clear-cut answers. These judgments often involve evaluating risk, understanding the context of transactions, and making decisions based on a combination of established guidelines and experience. Examples include evaluating the materiality of certain transactions and assessing the reasonableness of estimates made by management. Unstructured judgments are the most complex and subjective decisions auditors make. These judgments are made in situations where there are no clear guidelines or established standards to follow. Auditors must rely heavily on their professional expertise, experience, and critical thinking skills to arrive at appropriate conclusions. Unstructured judgments are often required when dealing with novel, complex, or ambiguous situations that fall outside the scope of standard auditing procedures. Examples include assessing the likelihood of financial statement fraud and evaluating the appropriateness of accounting policies for unique transactions, such as Level 3 fair value measurement of highly complex investment assets. The continuum of audit judgments reflects the diverse nature of decisions auditors face during an audit engagement. As the judgments move from structured to semi-structured to unstructured, the level of subjectivity, complexity, and reliance on professional judgment increases. Auditors must balance their adherence to established standards with their ability to adapt to unique and evolving situations in order to effectively fulfill their role in providing accurate and reliable financial information to stakeholders. There are three overall areas where auditors exercise judgment. Auditors exercise professional judgment extensively when evaluating audit evidence, as the process involves assessing the reliability, relevance, and sufficiency of evidence gathered. Examples include assessing the source credibility. Auditors must determine the reliability of the sources from which audit evidence is obtained. For example, when evaluating financial transactions, auditors need to consider the credibility of the documents, such as invoices or contracts, to ensure they are genuine and accurate. Another example includes estimation uncertainty. Auditors encounter situations where management uses estimates such as allowance for doubtful accounts or fair value of assets. Auditors must evaluate the reasonableness of these estimates, considering factors like historical data, market conditions, and management's expertise. Determining the appropriate level of scrutiny requires professional judgment. Auditors also estimate probabilities, and that involves assessing the likelihood of future events occurring based on available evidence and knowledge. For example, the assessment of fraud risk. Auditors assess the likelihood of fraud occurring within an organization. This involves considering factors such as the presence of internal controls, management integrity, historical patterns of fraud, and changes in business circumstances. Auditors exercise judgment to determine the likelihood of fraud and to decide on the appropriate audit procedures to assess the risk. Another area is assessment of going concern. Auditors evaluate the entity's ability to continue as a going concern. They estimate the probability of the entity facing financial distress within a certain period, often referring to as the going concern assessment period. This estimation requires considering factors like cash flow projections, debt obligations, and market conditions to determine whether the entity can continue operating without significant financial issues. Auditors also assess and use judgment when deciding whether to extend audit tests or not based on the assessment of risk, the sufficiency of evidence gathered, and the need to achieve audit objectives. The decision-making process involves considering various factors to determine the most appropriate cost of action. It is driven by the objective of providing reasonable assurance that the financial statements are free from material misstatement. For example, auditors have to evaluate the quality of available evidence. Auditors evaluate the sufficiency and reliability of the evidence they obtain thus far. If the evidence is limited, ambiguous, or lacks consistency, auditors might choose to extend testing to gather more conclusive or reliable evidence. Insufficient evidence could indicate that there is a higher risk of misstatement that needs further investigation. Also, upon testing, auditors might identify inconsistencies or anomalies. The presence of inconsistencies, anomalies, or unexpected result in the data or documentation might prompt auditors to extend testing to investigate further and understand the reasons behind these irregularities. As this word cloud indicates, good judgment entails a number of characteristics. I will expand on a few. Informed decision making. Good professional judgment is based on a thorough understanding of the subject matter at hand. Auditors should have a solid foundation of knowledge, relevant information, and an understanding of applicable rules, regulations, and best practices. Auditors should also exercise critical thinking. Auditors with good judgment are adept at critically analyzing complex situations. They can assess information, consider multiple perspectives, identify key issues, and make decisions that are logically sound. They should also be able to balance objectivity and subjectivity. While professional judgment involves subjectivity to some extent, it should always be grounded in objectivity. Auditors should be able to set aside personal biases and external pressures to arrive at decisions that are fair and impartial. Experience is also an important characteristic. Auditors who have encountered similar situations in the past can draw from their experiences to make well-informed decisions and anticipate potential outcomes. Auditors should also consider the ethical implications when making decisions. They assess the potential impact on stakeholders, adhere to ethical standards, and make choices that uphold the integrity and trustworthiness of the profession. They should also be confident, but be humble. Good judgment involves confidence in one's expertise and decisions, but it's also important to acknowledge limitations and be open to learning from mistakes or feedback. Overall, good judgment is a blend of knowledge, critical thinking, ethical considerations, experience, and adaptability. Auditors have to navigate complex situations effectively and make choices that lead to positive outcomes from themselves, their organizations, and stakeholders who rely on the financial statements. The judgment process involves a series of steps that individuals take to arrive at informed decisions in various situations. These steps help guide critical thinking, consideration of relevant factors, and the application of knowledge and experience. While the exact process can vary depending on the context, here's a general outline of the steps involved in the judgment process. First, identify the decision. Clearly define the decision you need to make. Understand the problem, situation, or choice you're facing, and ensure you have a clear understanding of what needs to be decided. Determine the criteria that are important for making the decision. These criteria should include factors such as cost, efficiency, quality, ethics, and more. Auditors must establish the goals and objectives that their decision should achieve. Second, consider alternatives. Generate and explore potential courses of action or solutions. Identify various options that align with your objectives and criteria. Evaluate the pros and cons of each alternative. Analyze the information. Carefully evaluate the information gathered. Use critical thinking skills to assess the data's reliability, relevance, and accuracy. Analyze patterns, trends, and relationships among the data points. Make the decision. Based on the analysis, knowledge, and assessment of alternatives, choose the option that best aligns with your criteria and objectives. This is the point at which you commit to a specific course of action. Finally, document and articulate the rationale for arriving at your judgment. Documenting the reason behind a decision provides a clear record of why a particular choice was made. This transparency is essential for stakeholders to understand the thought process and factors considered when arriving at the decision. It holds decision makers accountable for their choices and actions. Further, Clear documentation helps effectively communicate this decision to others who may need to be informed or involved. It provides a reference point for explaining the decision to colleagues, team members, clients, or stakeholders. Again, remember that the judgment process is not always linear, and some steps might overlap or be revisited based on the complexity of the decision and the evolving nature of the situation. Effective judgment involves a combination of rational analysis, intuition, ethical considerations, and a willingness to adapt to new information. Framing refers to the way information is presented or framed to influence how people perceive and make judgments about a particular situation, issue, or decision. The way information is framed can significantly impact how individuals interpret and respond to the information. In other words, framing can impact decision preferences. The same situation framed in a different way can lead to different decisions. People might make choices based on how a decision is presented rather than on the inherent value of the options. As an example, the framing of information has been shown to influence how people perceive risk and gains. When information is presented in a positive frame, emphasizing gains, people tend to be more risk adverse, pursuing sure gains. Conversely, when information is presented in a negative frame, emphasizing losses, people may become more risk-seeking, opting for uncertain but potentially higher gains to avoid losses. Applying this to an audit setting, framing can impact auditors' assessments of risk. For example, presenting risk in a positive frame might lead auditors to focus on mitigating risk, while a negative frame could lead them to emphasize the potential for problems or errors. In summary, framing effects demonstrate the powerful influence that presentation and context can have on decision-making and judgments. To mitigate the impact of framing effects in an audit context, auditors should be aware of the potential biases introduced by the way information is presented. Recognizing how their perceptions and choices can be influenced by the way information is presented can lead to more informed and rational decisions. In addition to framing effects, cognitive biases can also impact judgment. Cognitive biases are systematic patterns of deviation from rational and objective thinking that can influence decision-making and judgments. These biases are often the result of mental shortcuts, heuristics, or emotional factors, and they can lead to errors in reasoning, flawed judgments, and irrational behaviors. Cognitive biases can impact how individuals process information, make choices, and interpret situations. They're a common part of human cognition and can affect people regardless of their intelligence or expertise. Recognizing and understanding cognitive biases is important for making more informed and rational decisions. Several cognitive biases can negatively influence auditor judgment, potentially leading to errors and impairing the effectiveness of audits. Here are a few of those biases that can impact auditors' judgment. Availability bias. This is the tendency to consider information that is easily retrievable as more important for a judgment. Auditors may give more weight to information that is readily available or easily recalled. This bias can result in auditors focusing on recent or vivid examples and overlooking less accessible information. Confirmation bias seeks to overweight and confirm evidence. Auditors may be inclined to seek and interpret information in a way that confirms their pre-existing beliefs or expectations. This bias can lead to overlooking contradictory evidence and failing to consider alternative explanations, which can result in incomplete or inaccurate assessments. Auditors may overestimate their own abilities or the accuracy of their judgments. This overconfidence bias can lead to auditors overlooking potential risks or failing to thoroughly verify assumptions, as they might believe they are less likely to make errors. Auditors can also be influenced by an initial piece of information, which is called an anchor, when making subsequent judgments. Anchors can bias auditors' decisions, leading them to adjust their judgments insufficiently from the anchor point. Auditors who rush to judgment may make hasty decisions or form conclusions prematurely without thoroughly considering all relevant information or evaluating the available evidence. In the context of auditing, the rush to judgment can have significant negative impacts on auditor judgment and the overall audit process. For example, when auditors rush to judgment, they may not have sufficient time to gather and analyze all relevant evidence. This can result in inaccurate assessments of financial statement assertions, risk, and control effectiveness. Because auditors operate in a group environment on audit engagements, in this setting, auditors may conform to the opinions or decisions of the majority to avoid conflict. This bias can hinder independent, critical thinking and result in incomplete scrutiny of issues. Motivated reasoning is a cognitive bias where individuals tend to interpret and evaluate information in a way that aligns with their pre-existing beliefs, values, or desired outcomes. This bias can lead people to be more receptive to information that supports their existing views and to dismiss or downplay information that contradicts those views. In the context of auditing, motivated reasoning can have significant negative effects on auditor judgment. For example, motivated reasoning can lead auditors to interpret ambiguous or uncertain evidence in a way that aligns with their existing beliefs. This bias can affect the objectivity and accuracy of their assessments. In sum, mitigating the impact of these cognitive biases requires auditors to be aware of their existence, engage in critical thinking, seek diverse perspectives, and use structured decision-making processes. Training, supervision, and a culture of open communication within audit teams can also help address the potential negative influence of cognitive biases on audit judgment. Professional judgment is a crucial skill for auditors to effectively navigate the complexities of financial reporting and auditing. It involves making informed decisions based on expertise, knowledge, and critical thinking, while remaining objective and transparent in the audit process. Auditors must be aware of the effects of framing and cognitive biases on their judgments to ensure that they make more informed and rational decisions.